Welcome to this 38th edition of Capital Markets. I'm Tempula Shaju, and together let's drill down on the program this evening. Let's start off with the outline, knowing what we will be bringing on board. It's still news that Nigeria plans to borrow 5.5 billion US dollars in Eurobonds before the year ends, and that's what the news wires say. But then here's a breakdown of how the issue will go. This was explained by the Director General of the Debt Management Office, to me, Ms. Patience Oniha, in an interview I had with her this week. And she explains how the issues will go, as well as some other matters regarding debt to cost servicing issues that we currently have in the Nigerian capital market. Let's listen.
So we're talking about 5.5 billion US dollars. 2.5 billion out of that is the only thing that is new money, new borrowing. And that 2.5 billion US dollars is for funding of the 2017 budget. Okay, so that's the new money that we're borrowing. The 3 billion US dollars, meaning the balance of the 3 billion US dollars, is actually a portfolio restructuring. Okay, it isn't new money. Essentially, what we're trying to do is our debt stock presently includes the domestic component is very high. It's about 77%. Domestic component is about 77, and external is 23. Our target is actually 60-40. Okay, but the more important thing is that we want to, in that domestic debt component, reduce the short-term, high-cost component and move that into external for two reasons. So that 3 billion is not new money. You're simply converting a Naira obligation to a US dollar obligation. Okay, so what that does for us, two things. Should government really be borrowing a lot short-term? The obvious answer is no, because we're financing projects and other things in the budget. So it first helps us extend the tenor profile of our maturity. So rather than borrowing through treasury bills, we shift that into 5, 7, 10, 15, or 20-year external borrowing. That's one major gain, and then your debt portfolio is more stable. The other objective we achieve, really, if you consider that treasury bills, for instance, are issued at a discount of about 18% upfront, which translates to an effective yield of 21% or thereabout. And even for the bonds that are longer tenured, we're issuing at yields of about 16.4, 16.7. If we compare that to borrowing in US dollars at a rate of about 7% at most, you see clearly a difference in spreads of up to 10%. So that's a huge saving on interest costs. Okay, so the debt stock, based on the 5.5 billion US dollars we're talking about, the debt stock would only increase by $2.5 billion, not the entire 5.5.
So, ma'am, how sustainable are these debts? The cost of servicing all of these debts is a major concern to the citizenry and the investors as well.
Okay, I think that's a fair question to ask. Like I said, the 2.5 is what goes in as new debt, not the entire 5.5. And in terms of debt being sustainable, what the 3 billion actually does for us is that it reduces our debt service costs, like I said, by about 10% on that 3 billion US dollars. That's what it does. Should we borrow at 18% interest rate in Naira or borrow at about 7% in the international? So already, while you're borrowing, doing new borrowing and restructuring, you're actually reducing your interest costs. The 2.5 billion US dollars, which is new money, we might as well have said, let's take that in the domestic market, but we're shifting it externally to reduce the interest cost so that it doesn't grow at those rates. So that's one part of it. In terms of being sustainable, like I said, that strategy reduces interest costs. By international ratios and the standards we have set for ourselves, our debt is actually sustainable. Debt to GDP that we have set for ourselves is about 19.4%. We're at about 17.5 as at June. Okay, that's one part of it. But in reality, I think we should always look at the initiatives of government on revenue. Okay, so debt to GDP is extremely low. It's low compared to other countries that are, including the advanced countries, the OECD countries, that some are above 100%. But the other side, really, which we need to address is revenues. So if our revenues were high and growing and commensurate with our GDP, really debt service wouldn't look so high, meaning debt service to revenue wouldn't look so high. It is because we have sort of not looked closely at how to increase revenues. So the debt that has been built up to finance the government's activities now look like they're high relative to revenues, but it's because revenues haven't grown as they should. And I think the Honorable Minister of Finance has been driving the initiative to increase revenues. One of it is the voluntary assets and income declaration. The FIRS is doing a lot. So there's a lot going on there. So in absolute terms, debt is not like the challenge or the burden. It's because we haven't achieved the targets we should for revenue.
So since 2.5 billion US dollars is the new issue, what do you make of investors' rating?
Like we said, this entire 5.5 billion is, we expect to issue it in Eurobonds. Okay, and you know, Eurobonds are issued like a debt security in the international market. So in terms of how they would assess us, clearly the rating is important. The various reform measures and activities of the government are important. But let's not forget that we've gone to the international market a number of times. So we have securities that are trading, there are benchmark rates there. So we'll be priced relative to rating and the investors' assessment of the performance of government. So we think oil prices rising is good, but really the focus of this government is to diversify the economy and grow the non-oil revenues.
Madam, a few days after you released data on Nigeria's total debt stock, a conflicting report emerged from another federal government agency as to how state governments in 2015 breached their access to the debt capital market. What do you make of this disparity?
Okay. The official records or process as contained in the DMO's external and domestic borrowing guidelines for federal and state governments and their agencies makes a provision that for state governments who wish to borrow, and states can borrow just like the sovereign in various ways, so they can do state government bonds. Some of them enjoy some of the facilities provided by the central bank, for instance, for agriculture, the commercial agricultural credit scheme. So the ratio there is actually 40%. So what the DMO does is when those requests come in, we look at their ratio, their debt service, existing debt, and what that new debt, so that new debt could be a bond or any other borrowing. If the ratio is not more than 40% of their revenues, okay, that is considered acceptable, because what you've said is the deductions from your revenues really should still allow the state some resources to do the business of government. So that's what we do. So the other agency you are quoting, I guess we would have to validate and ascertain where that information is from. But that's the process that goes through the Debt Management Office as well as the Federal Ministry of Finance.